Hello, this is Mike Swanson of WallStreetWindow.com. I've got a very special guest today. I'm speaking with Ike Iossif, who runs the website MarketViews.tv. How are you doing today, Ike?
I'm doing good, Mike. Thank you.
Well, thanks for coming to take the time to talk with me and my listeners. We spoke many times last year, but this is the first interview we have done in 2019. And, of course, we saw the stock market drop 20%, but it's since bounced back up, and you've given me a presentation that people can see along with this, and I'm actually going to link to it also. So what do you think is going on, and where are we going?
Well, Mike, there are a couple of things that I would like to talk about. And one is something we also touched upon extensively last year, and that is the danger of oversimplifying things. Now, last July, and in fact was July 21st of 2018, we did an interview, and I explained why the advanced decline line was not really representative of what was going on in the market. If you recall, and I believe our listeners recall, the main theme, the main argument last year was that the 80 line was doing great, the 80 line was making new highs, therefore the market was healthy. And in some instances that is correct. However, you need to put things in context. In that interview, and people can link to it and read it, I explained that because of the way the 80 line is calculated, making the argument that it was reflecting a healthy market at that particular time was out of context. And a couple of months later, it was proven correct because the market tapped out in late September and lost about 20%. Also, at the end of November 30th, we did another interview, and we discussed something that I also thought was a key thing to discuss at the time, and that was positive seasonality.
Well, one thing about the seasonality, as we did that interview, many people were predicting an end-of-the-year rally.
Well, absolutely. And during that interview, I also explained that you need to put things in context. If you look things in a vacuum, more than likely you're going to end up with the wrong assessment of the situation. Now, back then we had said that since 1990, we had only 6 incidents, 6 years, during which the S&P on December 31st had closed lower than November 1st. Those were 1994, 2000, 2002, 2007, 2008, and 2015. Now, 1994 and 2015 were flat years, they were consolidation years, and in fact, following these 2 years, we saw tremendous gains in the market. The other 4, they were flat out bear markets, and we saw losses nearly 50%. Now, the chart that we have, which is the first one for today, shows exactly what I'm talking about. We can see the flat market in 94, early 95, and then the launch of the great 90s bull market. And then we see what happened in 2000. We can see what happened in 2008, 2009. And then we go to 2016. We can see that was a flat market again. And then a great advance that saw the S&P rallying to 2975. Okay? So if you look at all this, we had something very rare, and that is a negative performance during the month of December. Now, on top of this, you have to consider some other data, which my good friend Mr. Peter Elias pointed out in the interview that I did a few days ago, and you were kind enough to also post it. And that was this. January, the first week of January was positive. The market usually goes up. The whole month of January was positive, and usually if we have positive January, the whole year is positive. That did not turn out to be the case. Something else is that if you look at last year, that was a midterm year of the presidential cycle. If you go back to 1922, we have had only 5 incidents during which we have had negative performance during the midterm presidential cycle. It was 1994, the market was down a negligible 0.2%. In 1978, when the market was down 7%. In 1974, the market was down 0.8%. And in 1913, when the market was down 20%. So, again, what happened last year has only happened very few times the last 90 years. And then the new year comes around, and then we have on Monday, January 7th, also a very rare and very bullish development. We got a Zweig breadth thrust. That is when the 10-day exponential moving average of advancing stocks on the NYSE divided by the sum of advancing plus declining stocks moves from below 40% to above 61.5 within a period of 10 trading days. This signal was generated on Monday, January 7th. I follow very closely a very similar signal by the McCollum oscillator, and that is called a breadth thrust. That's something that the late Kennedy gammets had named that way, and that is when we see a sharp advance within 10 trading days. In this particular case, from December 24th last year to January 9th of this year, in just 10 trading days, the McCollum oscillator went from minus 109 to plus 117.76, 220 point rally, okay? So in just 9 days, between the end of December and January 9th, we had 2 very important but conflicting signals. We had the very negative performance in December, the very negative performance in the last quarter of the midterm presidential cycle, and at the same time, we had the very bullish development of the breadth thrust in the McCollum oscillator or the Zweig breadth thrust, called any way you want. There are 2 different things, but they're very similar. Now, because I thought it was very important, I posted a series of interviews with people who have done work on this. I posted an interview with Mark Arbiter. I posted an interview with also my good friend Meissner, with Eric Haddock. I posted my own research, which I will discuss briefly, and I posted an interview with Peter Alidis, who is probably the last greatest market historian I know of. In my lifetime, I had the privilege to know 2 great market historians, the late Kennedy gammets and Peter Alidis. So Peter Alidis' research goes back to 1922, and I think it's important for people to have a long-term view of what is happening. But anyway, from my own research, using the McCollum oscillator data, going back to since I started the business, which was in 1990, we have observed this. Look at the first chart, which is the advance that we had from September of 1998 to actually October of 1998. And what we see here is that after the decline that we had from point A to point B, and the thrust that we got in breadth, we did have a retest of the lows, and we had the positive divergence by the McCollum oscillator. We saw the same thing in 2000. You want to say something, Mike?
Yeah, so that's like a positive divergence with
Yeah.
the indicator and the action in the market. And one thing, I saw a study that said or showed, looking at historical data, that going back to like 1920, um, every time the market has fallen 20%, it would rally and at least retest the lows, sometimes break them, but only two times did the market go to new highs. One was, I think, in the early 80s, and one was in the mid 1950s. In other words, when the market would fall 20%, only twice did it go to new highs. All the other times it made a double bottom, like these two examples that you have here, or the 90, yeah, 99, 98, and so forth. Uh,
More examples like that, and I don't want to talk too much. People can read the commentary or the link that
sure.
I posted. But the bottom line is, when you look at the data that is available, what we have seen since 1990 is that every time we saw a breadth thrust, then we had some sort of a pullback or even a retest of the previous lows before
Mm,
the market went higher.
okay.
As I said, because I consider both signals, the one that given at the end of December and the one that given in early January, as very important. That is why I did a number of interviews with people who have done their own research on the subject, and I posted also my own. Now, the point I want to make is this. If you look at this data, the most likely scenario is that we will get some sort of a retest, okay? And what I want to point out is this. We had a 20% decline in the market. And the commentary was, oh my God, the market declined 20%. That means we're going to have a recession. Well, we had four incidents in 87, in 98, 2011, and 2016, when the market fell either 20% or close to 20%, but no recession followed. So if you look at the 20% decline that we got last year, it may not be all that bearish. It may not be as bearish as it looks. Now let's flip the coin and look at the other side. The bullish Zweig breadth thrust that occurred happened with the S&P just 10% below the highest valuation extreme in history. And people can see what I'm talking about. I have posted a chart. So my question is this. If we got a breadth thrust in 1982, and then you compare that breadth thrust to the one we got a few weeks ago, are these two signals have the same importance? One signal happened during some of the lowest valuations in history. The other signal happened very close to the highest valuation in history. So do both signals have the same weight? I think any logical person would conclude no. You have to put things in context and not oversimplify things. The point I'm trying to make here is this. Last year, because it was the midterm presidential cycle, and since 1922, the market always goes up during the midterm presidential cycle, because the market goes up in the first week of January, because the market goes up during the whole month of January, that told people we were going to have a great market in 2018. And the 80 line also told them the same thing. It didn't happen. Now, looking at the data, okay, my view is we have two very important signals that one contradicts the other within 2 weeks. How do I read it? I read it as this, that the risk of being wrong is higher than what people normally think. And I believe that having strong convictions with regards to what may take place the next 90 or 100 days or the next 12 months will actually result in trouble. If you look at the breadth thrust signal, more than likely the market will have rolled over around 2600, 2650. It did not happen. As we're all witnessing, it's going higher. Does that mean the bearish signal we got from the performance at the end of December is negated? No. Does the bearish signal negate the bull signal? No. What it means to me, what it's telling me is that the risk of being wrong is elevated. So I could easily see both scenarios, actually both signals playing out. We can see the bullish signal from the Zweig breadth thrust playing out, carrying the market up to 2800, 2850, and then the bearish signal generated by what I mentioned earlier kicking in at that point, and then the market turning over. So the bottom line is this: when you get very rare but very important contradicting signals, what investors have to have is a plan B. And this is not the time to have strong convictions. This is the time to let the market do what it has to do and have a plan to go along. Because more than likely, no matter what your conviction is right now, bullish or bearish, in the interim will prove you wrong. You may be proven right in the longer term, but the interim you can be proven wrong. And the problem is, if you have lost your money in the interim, it doesn't make any difference if in the long term you're right. And that's my message. Now, I do have a couple of other things to say that we will discuss next time, sometime next week.
Well, one thing about what you're saying is, well, I want to ask you, and then I'm going to ask a question. I'm going to give my solution, then I want to ask what your solution is. But I think you're right, and that creates a very challenging environment for people, and a more risky environment for people. And last year, there were lots of movements that whipsawed people, everybody. I was whipsawed to a certain extent because I was going short the market in the summer. I got out of those positions in August, but I got out of gold positions in the beginning of August too, and then I ended up buying those back, and then I was long the stock market at one point and got out, and anyway. But around Labor Day, I started to realize that the market is getting more volatile, or has the potential to become more volatile and challenging. And I was happy with, what I did from then on. But one of the things I did was I reduced my exposure to any one single thing, and actually started to, by the end of September, have cash reserves. I got out some stuff to have cash reserves, and I stopped being fully invested in anything. And I think it's just very difficult to be fully long the stock market or fully short the stock market, even if you're right in whatever direction it's going in this type of environment. And it's so easy to be whipsawed. And if we're approaching a time, in a window sometime in the next couple months, where this contradiction in the action at the end of the year and the other indicators that you mentioned will play out, and this contradiction will end up being resolved, it's very difficult to be on the right side of that if you're 100% short or 100% long this U.S. stock market. So I think I'm just trying to say my solution is to not there's to deal with the volatility by not being fully in, and you can therefore adapt more later is what my belief is. But how do you think people, I mean, that's not the only solution. What other things should people do in this environment?
Well, actually, I mean, the easiest way to control the risk is by having positions of small size. That's the most, in my view, that's the most
That's
obvious
what I
way.
mean. That's what I did. That's an easier way to put my ramble. I've reduced my position size.
Yeah, because what's happening is you also have to consider the psychological factor when it comes to investing and trading. And that is, if you have a position that keeps you awake at night, that is a very tough position to hold, even if you're right. And more than likely, you are going to be right, but you're going to be kicked out of your position because you can't sleep at night.
That's right. That's right.
So people really need to consider the psychological factor, which is if you take a large position on something that's going to have large volatility, are you going to be able to keep it? Or are you going to be able, or will you be forced to sell it at a loss? And then 3 months later to find out you were right. But so what? As I said, you could be right in the long term, but if you have lost your money in the interim time, it makes no difference. You're out of the game. And I believe 2018 proved that. I also believe the early signs indicate that 2019 will be a similar year. So my advice to investors is this: if you want to control risk, have small positions and don't have strong convictions.
And the other thing I believe is really have to be on top of what is happening in these markets, especially now in the next couple months with just your presentation shows that. So I'll be very interested to see what you have to say next week, and looking forward to that too.
So my Mike, thank you.
Thank you. And if anyone listening, if they want to get more information from you, they should check out your website, marketviews.tv. And also you just added a YouTube channel, marketviews.tv. People can subscribe to also. So thanks for taking the time to talk with me. And
Thank you, Mike. Looking forward to talk again next week.